Hello, I'm Tim.
And I'm Rebecca. We'd like to take a few minutes to explain how traditional private equity works, then show you how we have dramatically improved the conventional business model of the last 30 years.
Private equity is the practice of using private money to buy a portion of or all of a company at a low price, then sell the stake at a higher price. Buying and flipping companies in this manner is typically done over a 5 to 10 year cycle. The sale of a private equity acquisition is often to another private equity company or made through a public offering called an IPO.
Within conventional private equity models, there's a general partner, or GP for short. GPs run the company. The 5 to 10 year cycle we just referenced includes the GPs initially raising cash from limited liability partners, or LLPs for short, then using these funds along with borrowed money from a bank referred to as debt leverage to achieve the amount of funding necessary to buy their takeover targets. LLPs are typically institutional investors.
When an LLP joins a private equity fund, the GPs typically charge an upfront fee as large as 2%. This upfront fee generates a sizable sum of money for our competitors, hence the reason they charge such fees. We've designed a business model that has a higher profit potential for all the partners, including the GPs, yet without charging LLPs upfront fees. In a conventional private equity model, once an LLP invests money into a private equity fund, most, if not all, of this money is at risk. As you'll soon learn, this is not the case with our improved business model. If a private equity fund turns a profit, the LLPs typically receive 80% of the spoils, while the GPs receive 20%. Over the last 10 years, private equity has generated a 14% annual ROI as an average right through the GFC years.
Hundreds of new contenders have entered the private equity arena over the last 2 decades, thereby driving up the cost of asset acquisition. And since the GFC, banks have reined in debt leverage multiples. The result? ROI potential may finally be decreasing for traditional private equity firms. We would argue that a major flaw with existing private equity models is that these firms are constantly running inside a metaphorical hamster wheel, continuously looking for LLPs, constantly leveraging LLP funds with bank debt that is getting harder to secure, endlessly trying to find new assets to buy and sell at ever-increasing prices due to fierce competition, and then finally dispersing the profits, if any, and forever starting over again.
Like many top-performing investments, conventional private equity of the past has been a rich man's game for those who've had big money to risk. Some private equity firms have done well, others have not. Lastly, traditional private equity has poor liquidity. All money invested is locked in and is only paid out at the end of an investment cycle that often lasts 5 to 10 years. I'd like to now turn you over to Amber and Alana to have a look at the new model designed by PE Fund.
Thanks, Tim. In our model, we also have GPs consisting of working partners who run the private equity company and early-stage investors who put up some of the initial capital to meet the capital reserve requirement for a number of specialized licenses essential to make our model work, such as insurance intermediary and underwriting agency licenses, financing and lending licenses, and pension fund management licenses.
Collectively, these licensed entities will be operated by our GPs with senior banking, fund management, accounting, auditing, legal, risk management, insurance, and business experience. And just like a conventional private equity group has LLPs, our model does too. However, although we welcome large institutional investors, we cater specifically to the needs of the small LLPs, including individuals and self-managed pension fund operators.
An individual pension fund may have from as little as $500 for a person just entering the workforce, to as much as $1 million for a more senior person in their 50s, compared to many billions of dollars under management that large pension funds manage. However, collectively, self-managed pension funds are a multi-trillion-dollar market that our business model was specifically developed to cater to.
We offer many advantages no other private equity company can. The first major difference between our model and most is that we have no minimum investment requirement, hence the reason we invite individuals and self-managed pension funds to join us as LLPs, versus the majority of private equity funds that do not cater for this smaller investor.
Out of the more than $30 trillion in funds under management, we will choose to remain a boutique fund operator and manage a pension fund under our umbrella private equity fund that will range from a low of $20 to a high of $100 billion. This represents a market share of only 0.06% to 0.3% that we believe to be very attainable fairly quickly. We are only seeking to reach a market share of far less than 1%.
As we mentioned, another major difference between our model and others is that we will never charge the typical upfront fees other fund managers often do. The shocking truth is, most pension fund money is hit with a 2% fee more than once, because multiple companies may be involved in the management of pension funds, and each company in the chain charges as much as a 2% upfront fee. Compare that to a 0% upfront fee we charge. Our goal was to design a more fair and sustainable model, and we have done just that.
Why are we going through the trouble of operating a pension fund in addition to a private equity fund? Tim and Rebecca will answer this seemingly odd conundrum.
The answer, Amber, lies in the fact that operating a pension fund, in addition to a private equity fund, gives us the license to collect up to $100 billion from LLPs, yet never have to seek out funding again.
At PE Fund, we're able to fully risk mitigate our LLP's principal, so we never have a need to use funds under management to buy assets the way conventional private equity does. The reason for this is because we leverage this money differently than other private equity companies do. But the question arises, if we do not leverage the principal with debt, nor do we buy assets with it, how do we create wealth for all of our pension fund partners?
The answer to this question has to do with the way our fund's mandate is set up. We have bank and insurance partners who will pay us very significant passive interest income for the use of our LLP's funds under management to run their financing operations. In fact, we own an existing and rapidly growing insurance operation, so we have complete control over the high compound interest it generates, and we'll also have the entire facility insured by major outside insurance underwriters, thereby mitigating the risk. In effect, what we've created is a two-stage fund. The first stage of our unique private equity model only allows the fund to earn passive income on the portion of the funds under management which have been designated as fully risk mitigated. With this risk-mitigated model, we have the potential to generate an ongoing amount of investment capital without ever touching our LLP's funds under management, thereby reducing the risks to zero when layered with our other safety nets. As far as we know, no other company in the world has this level of risk mitigation. Rebecca will now explain how the funds flow into Stage 2.
A portion of the annual interest we will earn flows to the GPs to run the operation and compensate our early stage partners, and a portion flows into an ongoing investment cycle where the funds are used to acquire a very special asset class that is not only recession resilient, but also recession responsive. These assets have as much as 100 times to 1,000 times capital appreciation potential due to the fact that they can be acquired through our partner companies' close affiliations at 10 times to 100 times less than conventional private equity companies must pay for their assets.
Another huge difference between our model and conventional private equity is that we will only sell an acquired asset if it underperforms. We are not involved in the buy and flip game. Selling an asset is unlikely for us because the majority of asset classes we will buy into are already typically fully monetized at the time of acquisition and have a very strong double to triple-digit growth record that increases during tough or bad economic conditions.
Lastly, because our LLP's funds under management are never used to acquire assets, we can offer a very attractive 90-day liquidity option, meaning an LLP can have their money back in 90 days versus an average of 5 to 10 years with traditional private equity models. We created a new private equity model that no other investment firm in the world can compete with in terms of collective benefits offered. Now back over to Amber to recap the benefits that PE fund can offer to LLPs that are unique when taken in aggregate.
Thanks, Rebecca. The key that sets us apart from all other funds is that we can offer 5 powerful and distinct benefits to LLPs concurrently. 1. The option to specify the precise level of risk desired, right down to complete risk mitigation. 2. Maintaining a very high ROI potential, even though the risks can be fully mitigated. 3. PE fund can do all this, yet there are no upfront fees charged. And 4, our LLPs maintain excellent liquidity options with no risk of loss to money under management. And add to these 4 points the fact that the LLP partners have both a phenomenal capital gains and high dividend component, and we think you'll agree that this is a unique investment opportunity without comparison.
That's right, Amber. This is an opportunity for individual investors and self-managed pension fund operators to invest that is without equal. Add to this that in many countries, people can even receive a tax-deferred saving plan status or the equivalent thereof, meaning that the investment profits are not taxed until withdrawal, or at the very least, taxed at a preferential rate that is much lower than income tax. And you have a winning formula for success for all parties involved, including, of course, the partners at PE Fund.
From the entire team at PE Fund, thanks for watching. Be sure to watch some of our other educational videos.